Well, hello and welcome to this Diwali special co-presented by Motilal Oswal. I am Nandita Khemka. Well, after a fantastic year of returns where we saw a 30% return on the index level, is it time to really temper your expectations? Are valuations still a cause of worry after the recent correction that has shaved off almost 8% from all-time highs? What should one really do here on? Well, I am now joined by Anand Rathi, who is the founder of MIRA Money, to talk about the outlook for the next year and what is it in terms of themes that one should be watching out for. Welcome to the show, Anand. Great to have you here with us. And of course, first of all, wishing you a very, very happy Diwali. My first question to you is, we've seen an almost 8% kind of correction from all-time highs. What's your sense now? Are you comfortable with the valuations, or do you expect another 5 to 6% drawdown from here on to really say that valuations have turned comfortable?
Thank you, Nandita, and wish you and your team a very happy Diwali in advance. In terms of corrections, I think it looks like we are near the bottoms or somewhere close to the bottoms. Of course, when you invest in equity anytime during the year, you can always see 5 to 10% corrections, and that is something very normal. And I think we are somewhere closer to that, maybe another 2-3% if at all it falls, because Nifty is trading very close to its fair value at this point in time.
All right, one of the key reasons why we saw this fall has been the FII outflows, right? A 10 to 12 billion kind of outflow we've seen. And, of course, no points for guessing. China has come back to life, and which is something that could be leading to a rebalancing where FII money is concerned. But, if you look at it, stimulus-wise, it has been fairly underwhelming, right? But from a valuation standpoint, China does have an edge over India. So with 10 to 12 billion kind of outflows this year, do you see more flight of foreign capital, or would you say that the bulk of the selling is behind us?
So I think FIs were looking for an avenue to park the excess money, which is wherever there is an equivalent opportunity like India. And China incidentally came out and said, okay, I'm going to boost the economy with so and so stimulus. And that's one of the reasons why FI said, okay, let me exit India and then get into markets like China, Japan, Indonesia, and other cheaper markets. Yes, the stimulus is going to take some time. It is not going to happen overnight. But the rally that we have seen in the Chinese economy or the Chinese market is primarily an expectation rally. FIs may pause here, watch out for a few more signals, watch out for how stimulus is going to play out on the earnings of those companies, and then, of course, push more and more money into China. So India, in which ways, was at FI's participation was pretty low in the last few years, and I think that is going to continue because today we also may have another competitor in the form of China. Maybe another $5-10 billion can happen in the next couple of years. I don't see beyond that because there's also new inflow of money that is going to come in from US because of interest rates.
All right. But, post US elections, when that risk is over, do you see money coming back or finding its way back into India?
I think so because, right now, I think all that FIs have done is rebalancing of their portfolios. The year is near, so maybe they would have actually exited out of India to book some real profits and show it on their books. And once the election, uncertainty is over, and if let's say one or the other finally takes a stance, it means, they can take a clear view. Okay, I have so much money. Let me go to China 100% or 50% and into India 20%. I think that is going to be back, but I don't see that changing immediately. Maybe around January is when FI should be back with a newer set of allocation to India.
Right. Let's talk about, the domestic equities then. It's been a fantastic year, both in terms of equities as well as precious metals, right? You've seen gold also give good returns. Silver has, in fact, outdone gold as well, right? So going into the new Samvat, what should the ideal asset allocation be for next year now?
So I've not been a big fan of gold ever. It doesn't do the duty that it is supposed to do, which is hedging against uncertainty. In India, of course, it is done well, primarily because it's a great tool for you to invest if you want to hedge your portfolio against dollars. I'm not a big fan of gold, as I mentioned earlier. But at any given point in time, your portfolio can strategically have about 5% in precious metals. And tactically, when you see these kind of rallies, when there is a lot of money gushing into gold purchase, you can actually increase your allocation to 10% tactically, but then come back to 5% strategically as a part of your portfolio. majority of your portfolio should continue to be in equity if you don't need the money for the next 5, 7, 10 years or so.
All right, fair point. But what about fixed income? There's been a fair bit of euphoria when it comes to equity markets. Do you think it's better to now turn to fixed income over equities? Perhaps for investors who are a little risk averse now?
Oh, very, very true. I mean, I think India's yield is very high at the moment, closer to 7%. I'm talking about 10-year government security yields. If RBI starts cutting its interest rate today, at every RBI monetary policy meeting, we are all speculating when the cut is going to happen. Last time we thought it would be December. This time it looks like it's in February. So the yield is continuing to be very high at about 7%. And if you're an investor who doesn't need the money for the next 2, 3 years, in fact, you could actually allocate a sizable part of your debt portfolio into government security, which is a good play. In fact, you can actually make double-digit returns in debt if the yields starts coming down post RBI cutting its interest rates. I don't think you can compare equity to debt. Debt, yes, can be about 10-15% of the portfolio, depending on the kind of person you are. But equity should predominantly continue to be a part of your larger part of your portfolio for sure.
Okay, so equities, can continue to be a larger part of your portfolio, but markets have or are traditionally a slave to earnings, right? Earnings thus far have been disappointing. We've seen what has been happening in the second quarter. Most of the companies have even, outdone the muted expectations that really we had. They have been below estimates, and stock price reaction has also been quite brutal. So, looking at all these factors, where do you see potential now in terms of themes, that are well poised both in terms of earnings and valuation comfort?
Yes, earnings have been pretty disappointing. In fact, we thought earnings will be muted, but it turned out to be even worse than what we thought. And that's why the markets have reacted. We may actually blame FIIs and we can also blame the war situation. But truly, honestly, it is the earnings disappointment that is playing out on the market. And I think till the time the next set of earnings come in, which is in January, I think this will play on people's mind for sure. And then the next outlook that we want to see is how is this GST number going to be? Traditionally, post Diwali is when you get the second highest GST collection. If we see a significant jump, which means consumption is good, I think that will set the tone for the next couple of quarters. So that is a number that we are all keenly watching out for. And of course, on-ground situation for the businesses. But overall, in terms of sector, I think it is to be okay to be a little more conservative at this point in time. Your allocations can be a little more into IT, pharma, and maybe a good set of banks that you should invest in. I keep focusing on quality banks because banks also have got a lot of murk, and then we need to make sure that if you're playing, I think earnings will be very, very good in few good quality banks, and that's a very, very good play other than IT and pharma.
All right, IT, pharma, banks, these are some of the top themes to watch out for in the new Samvat. But any contra themes that you would stick your neck out and say that although, stock price movement has been adverse, perhaps they may have even disappointed in terms of earnings, but any contra themes that you would stick your neck out and say that, this could be a story to watch out for?
A very radical thought. This has been coming to my mind. We are all, I mean, FIs are all getting bullish about China. And, I'm thinking silver could be a good play at this point in time, primarily because silver is an industrial metal. A lot of its demand is from industries. We are all shifting to clean energy, which means a lot more silver will be used. So if you really want to play very contra, this is against equity, this is against debt. You can actually look at investing in silver ETFs or silver funds because it will have a lot of volatility, but then you may want to play a pseudo China play on your portfolio using silver ETFs.
All right, and last question really, any advice for a young audience for wealth creation, people who are just about getting started in their wealth creation journey, what kind of advice would you give, for the next couple of years?
So I'm sure a few of us are feeling or seeing the markets for the first time, right? Falling for the first time rather. This is not the first time it will fall. I'm pretty sure you are going to see 5, 7, 10, 15% kind of a correction almost on a yearly basis. But if you're a long-term investor and are in equity for wealth creation, these are going to be a part of your overall, portfolio strategy. You are going to see more and more of these corrections. Take it in your stride. Make sure you stay invested and use this opportunity to top up your portfolio, because this will play out very well in the longer term for your wealth creation. So please stick to your investment philosophy and take these falls in your stride. That's my advice to these young investors.
All right, one more question, if I may add. If somebody was looking to invest somewhere around 10 lakh rupees in the current market situation, what should that, or where should one deploy that money, and how should the portfolio construct look like?
Okay, so now 80% of your money should get into equity for sure, provided you don't need this money for the next 5, 7 years or so. Out of the 80%, my allocation style would be 90% of the money will get into large caps, because that is where I see a lot of valuation comfort, and maybe a little bit into small caps. Mid caps, we can still wait and watch. And for the remaining 20%, go very high on debt, in my opinion, as high as 15%. Long-term GSEC papers is something that you should buy. And the remaining 5% could be in precious metals or a contra call, like instead of taking gold, you may also try and buy silver. This is what I would think. So 80% equity, out of which 90% will be in large caps, 15% in debt, and 5% is going to be in precious metals, either in gold or in silver.
All right, point taken. Well allocated. Then 80% in equities, 10% or 15% rather in fixed income, and the rest of it in precious metals. With that, Anand, would like to thank you for taking our time and joining in for this, Diwali special. Wish you and your entire team a very happy Diwali from the entire Money Control team. Thanks a lot for joining in.
Thank you.